What we have is the yield curve over here, and then we have the S&P 500 over here. And what you're going to see is that the yield curve is going to start moving in a dynamic fashion as we move through the peaks and the troughs measured by the S&P 500 or stock prices. And this is probably the more accurate measure. It's not a measure of a coincident indicator such as gross domestic product or industrial production or a lagging indicator like employment. It's a leading indicator. So the stock market is a leading indicator because prices are going to move based on expectations of not only interest rates or the cost of capital, but also the prospects of revenue growth and earnings growth and net operating income and dividend growth. So this is a predictive indicator. And what you're going to see is that the yield curve is going to move up, as you start to get to the peaks. It's going to invert as you get to the peaks. And we haven't inverted yet in the most current cycle. It's going to be bid back down as you move into the trough or the market correction and you reach the bottom of the stock market bottom. Then you'll start to see that the Federal Reserve will continue to have accommodative monetary policy through printing money and buying bonds and driving up bond prices and keeping interest rates low. And you'll see it'll become a normal curve down in here, and then it starts to flatten and invert at the peak. It starts to get normal again as we move into the correction and the trough. It'll stay normal through most of the recovery period, and in the current stock market rally, or the bull market that we're in right now, we haven't seen any indication yet of an inversion in the yield curve, which probably means that there's more runway space for the equity markets to continue to appreciate, because 9 times out of 10, the yield curve will invert a year before the stock market peaks, and it doesn't look like that's going to happen anytime soon. So that is a bullish signal. So let's go through the animated process. So I just clicked on animate, and you can see as we start to get towards the peak how flat the curve is. So the Federal Reserve is starting to sell off its bonds, drive down bond prices and drive up interest rates as we start to get closer to the peak in the stock market. And just watch, within a few minutes here, as we get towards the peak, it inverts. See, it's already inverting. The economy is overheating. We probably have an equity bubble. And now we start to move into a market correction. The Federal Reserve is scared that the economy will move into a severe recession. To mitigate that, they start to buy bonds, drive up bond prices, drive down interest rates, and you start to see the curve start to turn normal. One thing to notice is look how far down interest rates go in the 02-03 recession. You'll see how far interest rates go in the 08-09 recession, where they actually take interest rates to 0, which is completely unprecedented. And the other thing to learn, as we start to approach the next stock market peak in 2006 and 2007, how steep the curve gets, because the Fed is just buying bonds, just trying to keep the market rally and the economy going to continue to grow. But at some point, as you can see now, it's starting to flatten. It's starting to move up. So the Fed is obviously concerned about the economy overheating. Now they're selling off the bonds, and it looks like the curve is flattened and it's getting ready to invert. And look how close we're getting to the peak. There it goes, it inverts, and it looks like it inverted about a year before the last stock market bubble peak in 06 and 07. Severely inverted here. We've just peaked now at the end of 07. And then you'll see the Federal Reserve, as the market just crashes, and they come in and they drive short-term interest rates, the short end of the curve, to 0. So just watch. Oh, now it's approaching 0. So real interest rates at this point are negative, under an assumption of 3% annual inflation rate. 0 interest rates, you're looking at basically a negative 3% real interest rate at this point in time. And you can see how far or how accommodative the Federal Reserve has been, how much money they printed, how much bonds they bought, the prices, how they've driven those up and really cram down and buy down the interest rates. And what they're trying to do too is by bringing down and being aggressive in buying bonds on the short end of the term structure is they're actually trying to flatten the curve and drive down long-term interest rates. And that's through the term structure equation. But at this point in time, we've had low inflation, disinflation, deflation in some cases, domestically and globally. And we've had currently, as you can see, as we get towards the current stock market peak, right now it doesn't look like there's any inversion within any time soon. And with the massive amounts of capital flight coming out of Russia, coming out of Latin America and Asia, it's keeping the yield curve lower. It's still upward sloping, but interest rates are extremely low right now, and that's the current, and I don't see any inversion. So theoretically, if the inversion in the yield curve is a precursor to the peak or in a pending recession, it doesn't look like there's one in our near future for at least another 12 to 24 months, maybe even 36. So let's cut it down.